Good morning, good afternoon, depending on where you are. My name is Keith Duran. I'm the Senior Vice President of Business Development for the company. We are joined, as always, by Jim Warner, who is the Head of Research and Co-Portfolio Manager. We'd like to say thank you for spending your time today with us on this strategy update. As you know, for those who've joined us before, these are really about 30 minutes or so of sort of an economic backdrop, but probably more importantly, how this data, affects our portfolio. So if you have a good understanding of our themes like AI and energy, electrification, golden age of healthcare, mortgage REITs, et cetera, then you understand what's in the portfolio and you understand how this affects the portfolio. So after Jim's prepared remarks, we're going to take some questions. So we encourage you to ask away on the bottom of your screen if you touch the or on your computer, but if you can bring up at the bottom, you'll see a Q&A box. Please just go ahead and ask those during the presentation, and then we'll address them at the end of Jim's prepared remarks. So without further ado, I will hand it over to you, Jim.
Great. Thanks, Keith. Thanks, everyone, for joining us today. Let me share my screen here. Perfect. All right. Well, this month, what we're going to talk a lot about is the labor market. There was some interesting data that came out on Friday from the Bureau of Labor Statistics that caught some press, and we're going to go through a bit of that. And we're going to hit on a couple of other important things like where we are in trade deals. And then we'll wrap it up with kind of our own brag sheets of our performance, and we'll go through a bit about what we're doing in the portfolio. So let me get started. And yeah, as Keith said, if things come up and you have questions, please log them into the Q&A box. We'd love to take those questions. Okay, so the lemmings are now on board. It took a while for some of the market to realize that tariff uncertainty would be cleared up, that inflation wasn't going through the roof. And finally, you sort of had the last folks really kind of join the fun in this market. As we sit here today, the tariff deals are largely complete. I'd say at least we know how to box the problem, and when the street can kind of box the problem and quantify in generally where we're going on tariffs, that's usually when the market moves completely past them. So we're getting close to that point. There's very little trace of tariff-induced inflation. We'll have to wait and see. Of course, there's going to be some higher tariffs put through here with these new trade deals, but so far, so good. The job market has remained strong, but maybe not as strong as we initially were told, and we'll go through that. The global conflicts are obviously subsiding. We haven't bombed anyone very recently, and so that's generally taking some uncertainty out of the market. Corporate earnings. I've just told Keith, this is basically 4 weeks into the Q2 earnings season. If you can hear it in my voice, I'm exhausted. We've listened to dozens and dozens of calls, and generally speaking, corporate earnings are better than expected. And even companies that couldn't provide guidance for the year, like the airlines a quarter ago, and actually pulled their guidance for the year, are now providing guidance. Things are definitely looking better and more predictable as far as the corporate suites, executive suites are concerned. So market valuations have recovered. We'll talk a little bit about where they are now. And so the market's at record highs. So all in all, what you're seeing is that as uncertainty has trended lower on a variety of topics, the market has trended higher. So now what? And honestly, we wouldn't be surprised if there's a pullback. We haven't had a 5% pullback in a while. We could have that certainly this month or next month. So we'll just have to wait and see. We think that would be an enormous buying opportunity. We'll go through those reasons in a minute. But where we sit here today is the S&P 500 is up 8.5% for the year. The NASDAQ's up almost 10%. Pretty huge recoveries from the depths of April. And even the Dow and the S&P equal weight are hitting new record highs as well. Now, where we sit from a market valuation standpoint is fair to expensive. And if we separate the Mag 7 from the other 493 stocks in the index, the Mag 7 actually looks still reasonably valued. The chart on the left is the next 12 months price to earnings multiple, and the solid blue line up top is the Mag 7. The grayer bottom line is the other 493. And what you'll notice is that the Mag 7 really is pretty much in line with their historical multiples, at least for the last year. Whereas the other 493 is starting to look a little expensive. Sitting here in the low 20s is a little high. And normally, what that would mean for these generally more cyclical names is that we expect next year's earnings to be better than expected. And so we expect those estimates to come up. And what's interesting is if you look on the chart on the right, what the actual EPS estimates have been doing is that the Mag 7 has obviously just been trucking up and to the right pretty consistently. So things are going quite well there. Um, but the other 493 is a little bit of a different story. As you can see, there was a big dip in earnings estimates with pessimism over principally tariffs and potentially inflation. And that got baked into the sell side's numbers in during the spring. Now, as those worries and concerns have failed to materialize, those estimates have been revised upward. And now to a place that is, north of where they were going into the year when things are fairly upbeat. So I would pause here a moment just to say that, that's looking a little pricey to us. And so I think it's going to be really important to watch for whether we get a little bit of a pullback in some of these multiples. All right, we're going to spend some time on the labor market. Why? Because obviously, if people have jobs, they spend money, the economy grows. So it's really important. And we got some very interesting news on Friday. So the Bureau of Labor Statistics and basically came out with their typical monthly numbers for payrolls, non-farm payrolls. And on the one hand, they looked they seem to reiterate the story that we've known that the labor market is strong and hanging in there. The U.S. unemployment rate came in at 4.2% for July. You can see that on a chart on the left, and that's basically very strong. It's obviously bang in line with what we've been experiencing for the last 12 months, which obviously has been a pretty strong period for the economy overall. And so that part remains still looking pretty good. Job growth, though, is started to decelerate and started to weaken a bit. Now, what we got on Friday was two pieces of information. One was that payrolls grew 73,000 in the month of July. We also got some pretty big downward revisions to what was previously announced as the jobs that were created in June and May. And I'm going to go into that in a second. But you can see that that creates a real kind of soft spot here, which maybe that was induced by tariffs. Maybe companies basically paused hiring when the tariff announcements came in April, and you saw that kind of trickle through in terms of the lack of jobs added in May and June, and now basically they're starting to hire again. Maybe that's the story. Time will tell. But this report did raise the question of what is going on with the BLS numbers. The May revision was down 125,000. The June revision was down 133,000. These are pretty big revisions. And if I put these two charts, and it's a little bit difficult to sort of see firsthand, but basically, what I did here is I charted what the first revision. So every payroll report, there's the original report, which is the first Friday of the following month. And then there's the next time we get a payroll report, we get a first revision, and then we get a second revision in the following month. So there's two revisions. And what you can see in the first one is that almost all of these bars are negative. That means that the first revision versus the original reported number are generally always negative. And then you can notice in the graph on the right that these bars get bigger. It's because the revisions downward get even bigger as we go through the second revision. So we'll go through that in a minute in a little more detail, but the same thing spooked the market last year. If you remember, exactly 1 year ago, we got a very weak July payroll report, and it really freaked the market out. And that's when we had a pretty sizable pullback in the market. Now, that proved to be a dip worth buying. but it raised concerns about stagflation. You start to hear that, right? I would not be shocked if we see a little bit of a pullback, really on just because people are going on vacation and taking some profits. And you might hear some talking heads say, "Oh, it's stagflation all over again." I don't think it is, but these labor numbers do certainly support the idea that things aren't as strong as they are originally reported to be. And I went back and I looked at each of the last, I guess, 13 months of data. And what you can see is that 11 out of the last 14 reports have been, the original number has been revised lower. So, you know, what's really remarkable about this too is that this is a very important data point. I mean, this is a market moving data point that when things beat, that's generally good. But it also can raise questions about inflation. So, the bond market moves, the stock market moves, and all I can tell you right now is that these revisions seem to be getting larger and larger as over the last few months. So let's just try to cut through the noise a little bit and see what really matters, particularly as it concerns the economy. So one of the things that I do is I take out the government jobs, and this is the federal government, this is state and local, it's also the post office, for example. And if you strip all that out, you see that the 73,000 number for July goes up to 83,000. But honestly, the pattern doesn't really change a whole lot. And as I mentioned, I think that time will tell, but it could very well be that the pause that we see in kind of this May, June timeframe was tariff induced. And as the tariff situation gets more clarity, we could see a recovery in the job market. Don't know. It could also be that once there's clarity in the job market, on tariffs, that you actually see layoffs. It's totally plausible as well. But what you can see is that this created a bit of a spike in unemployment claims in June, and now that's come down. So there's definitely some noise, and time will tell and provide us more clarity. Now, the reality is we have a better alternative, and it already exists. It's been around for, I don't know, 10, 15, maybe even 20 years. And it's a payroll report that ADP, one of the largest payroll processors in the United States, provides just a couple days ahead of the BLS print. And as you can see from this data point, the numbers are roughly the same, and it shows kind of a similar type of pullback in hiring in April, May, and June that we've seen in the previous slides, and then a bounce back in July. So the trend isn't frankly wildly different than what the BLS is showing. It's just that you don't get the wild revisions generally with ADP. And the reason for this is that they process the actual payrolls for about 500,000 businesses with more than 25 million employees. So if anybody should be able to statistically extrapolate what this means for the entire economy, you'd think it would be ADP. So, but it does seem to confirm at least that we've been experiencing a bit of a slowdown in hiring over the last few months, and remains to be seen whether that's a trend that continues. One other interesting data point I'll touch on in the labor market is whether or not deportation of illegal migrants is actually having an impact. And the BLS actually has a survey that they conduct. It's called Table A7. You can find it on the BLS report. And it actually looks at the job data based on nativity, i.e., where you were born. And what's interesting is that since the Trump administration took office, and I think we've had a more active deportation schedule, at least that's what the press would lead you to believe, foreign-born workers are down 1 million, and between basically January and July. Meanwhile, native-born employment has actually increased 1.5 million. So just adding to the noise here could also be an interesting trend where you're seeing foreign-born employment down, and native-born up. Now, I'll caution you by telling you that the foreign-born it does include workers that are here illegally, but it also includes those that are here legally, like folks on H-1B visas and that sort of thing. So it's not a perfect metric for measuring the impact of deportation, but it certainly suggests that there is some sort of impact going on, and obviously that's going to have impact on certain industries more than others. So where does this all lead us to? Well, interestingly, the market has not really priced in a much higher chance of a Fed cut. I think there's still this sense, certainly if you listen to Chair Powell's uh, press conference after their meeting this past month, there's clearly a cadre of folks on that committee that believe that there is a chance for some bout of inflation from these tariffs, and that's what's holding them back from cutting. But and the market is essentially siding with that view. Right now there's a uh, roughly, more likely than not, we'll see a 25 basis point cut in September, and then maybe another in December. As you can see from the Fed futures, that there's sort of this gradual tick down to 3.2% in about a year. So what actually is what actually happens is pretty much anybody's guess. It's all going to be theoretically dependent on where inflation data and the job market goes. Our opinion, just to reiterate it, because I do it every month, is that rates are too tight. If you look at the Fed funds rate versus the core PCE inflation rate, it's still in a pretty restrictive territory. And I think most economists will agree, and even the Fed agrees, that the rates are still in restrictive territory. So we could drop them, in our view, you could drop them, 130 basis points, maybe call it at least 50 or 100 and not stoke the inflation fire. But it would certainly, I think, be appropriate given the weakness we're seeing in the labor market and the fact that we're not really seeing a lot in the way of inflation today to basically lower rates so that they're less restrictive. And along the lines of inflation, our favorite way of measuring inflation through Truflation, which is a real-time index that tracks millions of data points, real time. We're seeing inflation around 1.7%. So, at least below the Fed's 2% target rate. And so that gives us at least the view that rates should be heading lower, which, by the way, would be good for the market, right? You don't want to fight the Fed. Generally speaking, as long as rates are headed lower, and it's not because we're having a recession, that's generally good for the market. So stay tuned on that. The other thing I wanted to address real quick was GDP, which came out for the second quarter during the month, and it came in at a very strong 3%. But remember, 1Q came in at a negative 0.5%. And if you'll recall, I said on that webinar, don't worry about it. There's just a bunch of noise with pull forwards of imports as companies expected tariffs to come around. And that's basically this big red line that you see here on this graph was this surge of imports, which mathematically reduces GDP. And then the exact opposite happened in 2Q. So we're not really growing at 3%. It was just sort of the other side of pulling forward imports was that there weren't as many imports this past quarter. And you saw that adding to GDP. So I think where we sit right now is GDP is somewhere in the 2% range, which is a decent, sort of decent, typical number that you would see in the economy. So, not too hot, not too cold. Um, the other thing I'd just point out is, which is interesting when I was pulling this chart together, was that government spending is this yellow piece of the bar chart. And if you'll notice, there's no government spending right now. Since Trump took office, the government is not contributing to GDP at all. And obviously, some part of that has to do with, Doge and pulling in the purse strings. All right, let's get an update on trade deals. I just listed our top 10 trading partners, and as you can see, that there's a pretty material step up in these trades, even for those in which there's a preliminary agreement or even a completed deal. This really does radically change the the overall balance of trade globally. I think that was certainly the intention. But what I'll also point out is that these are nowhere near the levels that were threatened under the reciprocal tariffs that really scared the market. So there is going to be some adjustment that various companies will have to make. And we're starting, but I think once we get the rules of the road, I think that we'll have we'll be able to get more information from more companies as to how they're going to adjust to this new world order. In the meantime, tariff revenues continue to skyrocket. And I hear that July is coming in really hot. We won't get that number, I think, until sometime next week. But, right now, on an annualized basis, if you looked at the June numbers, the Treasury would collect $320 billion annually from tariffs. With the step up that is about to occur, that could go to 400, 500 billion. No one really knows right now, but that's a really huge amount of revenue, and certainly something that will help offset the budget deficits that will be created by the big beautiful bill, and ultimately provide some cover to what were projected to be the big deficits coming out of that bill. And as I said, we just don't know what the impact is yet on corporate margins, but it's not going to affect the entire economy. So there are certain businesses obviously are more acutely impacted. So let's talk about what we're doing in the portfolio. Uh, just to update where we sit here in terms of key catalysts. Like I said, I don't think you need a big excuse to be taking profits. We've been doing that in all of our portfolios. We've had a great run. There's plenty of reasons why we could see some pullbacks. Obviously, the trade deals, we've sort of gotten, I think, all of the relief that we will get out of them, and those are pretty well baked into the market. The second quarter corporate earnings season has actually come in much better than I expected. I mean, it's the AI and the power themes that we love have been incredibly strong. But what is interesting is that as the market has continued to climb, we're now seeing, now that we're in basically the fourth week of earnings, that no beat and raise to guidance, increase to guidance is good enough. You're seeing pretty much beats and raises and the stock's falling. So that really is a pretty clear indicator to me that, we could see an overall pullback in the market. But that's okay because, I think that's likely going to be very interesting by the dip moment, because things are really honestly coming in better than expected. The buybacks will start to be back in operation as companies come in and buy their own stocks. Who knows what we're going to get at September conferences, but all indications are, you're going to get more clarity on tariff impacted companies, on the impacts to their earnings. But generally speaking, things seem to be pretty good and picking up. And then we move into deregulation announcements. And I think that's going to be the next big leg of the Trump growth agenda. So you've gotten, tariffs, you've gotten the big, beautiful bill, and now you've got, hopefully some lower interest rates as well. A Fed cut maybe in September, and then you're going to get deregulation. And all of this to me is making me a lot more confident in what 2026 is going to look like. There's just a lot of positive catalysts and tailwinds that seem to be, that's going to propel a pretty solid 2026. So any pullback from my perspective is a welcome gift. So I wanted to address also kind of what have been our keys to outperformance. What's really driven it this year? And I think first and foremost, our themes are working. Obviously, as Keith alluded to, one of our big themes for actually quite a few years now is artificial intelligence. The more work we do on it, and I know I said this last month, but it is dramatically changing the way information is processed, and therefore probably the most radical, transformative economic development of our lifetime. It beats the internet. It beats mobile phones. When the history books are written, maybe 50, 100 years from now, it may be right up there with the invention of the wheel. It is so remarkable what AI can do, whether it's enhancing productivity. We've seen it in the way we use it, problem solving, general research, robotics. I mean, we've just started to hit the point where you're seeing the application more broadly. and it's not just some fun thing to, to type away in and get answers to. But it is really going to impact not just the AI industry itself. Obviously, we need a lot of power. And so our electrification theme has been incredibly useful and generated huge amounts of profits this year for the portfolios. And AI is changing every industry. So, it's impacting the way we think about investing in defense and healthcare, and financial services and manufacturing. I mean, these are all going to be significantly impacted in ways that we haven't even envisioned just yet. And so that's pretty exciting. And then even the commodities that make AI a reality are important, and those have been um, incredible contributors to the portfolio, such as copper, such as uranium, those sorts of things. So the themes have really hit it for us this year, and that's really been driving our outperformance. Um, I think also what's happened is that because we've had so much noise with the tariffs, that it's our process of doing real analysis with real data to drive our investment process and not letting political views cloud our ability to make decisions and judgments has also been a major reason why we've outperformed this year. um, I generally have always found that the best investment opportunities is when irrational fear is at its peak. But to be able to identify irrational fear is, not very easy sometimes. I mean, when everybody is saying the sky is falling, like back in April, it took some guts to stand up and say, no, it's not. And here are the reasons why. But we stuck to our guns, we stuck to our process, and I think that's one of the major reasons why we've outperformed. And like I said, I think 2026 is going to be potentially a great year for the economy. They'll see the benefits of the stimulus that's embedded in the big, beautiful bill. You'll see maybe lower interest rates. You'll definitely see lower trade uncertainty. So, we're pretty excited about what the future holds. Um, I'll go through these very quickly, and then we can take some questions. So, definitely think about anything you want to ask. But our tilt over the last year, we've been able to generate a 37% return. So that's been pretty special. As I mentioned, we have been trimming our winners. That's a nice problem to have. Our global vigilance moderate, we found out that it's beaten 95% of its peers over the last year. And I think as I always say, the most important part to us, because this is where a lot of our clients are in, this strategy, is these 10-year and since inception numbers of, almost 9%. What that means is that on an annualized basis for over 10 years, we've been generating almost 9% returns on a gross basis. And what that means is that we didn't just have a great year this past year. It means that, and not every year is a great year, by the way. But it means that we have a consistent investment process that also consistently generates good returns. And so, here again, we're taking the opportunity to trim some winners and look for hopefully a dip to buy some other names that we've had on the list. And of course, our conservative strategies also had great performance. So let me stop there, Keith, and let's take any questions.
Thanks, Jim. Two things. We do have a couple of questions. I was just going to say, for a man who lives in Florida, I don't know about AI versus air conditioning. I'm not sure. But anyway,
That
the other thing is
was a
that,
pretty good invention,
yeah, right, exactly.
AC.
And when you look at those numbers, I mean, when you look at the equities that we're holding, I think it's really a testament, right, to the themes and the thematic based investing that we do, because those numbers are incredible given the level of equities or risk in the portfolio. So we do have two questions. If 4 to 4.2% is essentially full employment, then why wouldn't the jobs number be low?
Well, I mean, there's a traditional amount of churn in the market at all times, and generally speaking, what you're going to see is somewhere in the neighborhood of 100, 100 plus thousand jobs for the market to kind of just sort of tread water. That's typically what you would see. So, we're a little bit below that trend right now. And, we'll just have to see where it goes from there. But, maybe, who knows? If the tariff impacts really are absorbed the way they could be absorbed, then, we might see, hiring reaccelerate. But, we'll just have to wait and see how this goes.
Gotcha. I love this second question. I know this is right up our alley, but have you or anyone really analyzed if the US energy infrastructure can provide enough supply to keep up with demand from AI? I know the short answer is going to be yes, we've done it, and no, there's not.
Well, yeah, I mean, we've done an enormous amount of work on this exact question, and I think the I mean, there's where we sit today, the answer is no. We don't have nearly enough power generation. We're not even close. And I think that not only do we understand that, but all the hyperscalers building these data centers know that, and the Trump administration knows that, and there is a there is a monumental amount of money being spent on solving this exact problem. And that is literally the key driver of our electrification theme is that, I mean, billions, if not, tens of billions of dollars need to be invested, if not more, in creating not just more electricity generation, but we've got to revamp the grid. And that entails a whole bunch of other things in terms of all the various different bits and pieces that go into an electricity grid. Um, one of the things, and yeah, it's if there's one big concern on the AI growth, it is around whether or not those data centers can actually get enough power to them. And will there be a pause because the supply chain and included in there is power generation, the power gen supply chain, can they actually build fast enough? What you're seeing is actually pretty interesting. I mean, and everybody knows this is a massive problem. I mean, you even have folks like Chevron and ExxonMobil building power divisions now, developing power divisions because they're really good at pulling, natural gas out of the ground and refining it and sticking it into, electricity generation. And so you're seeing also a lot of off-grid or what they call microgrids being created that literally it's power generation just simply for the AI data center. So yes, you've identified obviously what is probably the single biggest problem that needs to get solved in the economy today. And but here's why I think it ultimately can and will get solved. Number one, we know how to solve it. Number two, it is intricately tied to national security. There's 100, you can go read it. The White House just literally published multiple white papers on this. It is in our national security interest to have a sufficient amount of power generation to win the AI race. That is possibly the number one priority of the Trump administration. And so you are going to see some backbreaking efforts to make sure that that generation is created.
Interesting. I know, I mean, the rest of the world isn't afraid to build, um, you know, nuclear reactors. I mean, is that really ultimately the answer for the US?
It's part of the answer. Look, there's a lot going on in terms of these small modular reactors. And there's one that just got launched in Canada. There's others that are being built all around the world. Look, we've had administrations. The last administration hated the idea of nuclear, hated the idea of natural gas and fossil fuels. And so, in fact, what they were doing was they were actually decommissioning as many coal, natural gas, or nukes that they could possibly decommission, all in the hope that solar and wind was going to save the day. Now, solar and wind are great, but they don't always work, and they aren't the answer. They are part of the answer for sure. And so, you're still going to see those developments. But nuclear is very important because not only is it extremely clean and extremely cheap once it's up and running, but what it does is it creates a base load. So you can't really peak the nuclear reactors. They tend to like whatever you produce, that's what they produce. Whereas you can modify the generation of other sources, particularly natural gas. So natural gas is really good for just turning on when you need it in a hot summer day or a cold winter, and turning off what you don't need. So the real answer, honestly, is in the very near term is going to be natural gas. Natural gas is going to be kind of it's very fast to produce. It's obviously easy to pull out of the ground. It's easier to basically put it in a pipeline and get it to where you need it. Um, and you're seeing a lot of the next kind of layer of electricity generation will largely be nat gas driven. Um, there was a very interesting, if you listen to like the earnings call of GE Vernova, which produces a lot of the turbines and whatnot for electricity generation. They actually think that the natural gas market demand could increase so much that we could see, a lot higher natural gas prices in like 6 months to a year. So it's a multifaceted approach. By hook or by crook, they're going to try to get there, and nukes are going to be a very important part of it. It's just going to take some time
Yeah.
to really stick them in the ground.
Awesome. Well, that looks like those are all the questions. So with that, we'd like to say thank you again for taking time out of your day to join us for this webinar. We'll see you again in September. I can't believe it. Time's going way too fast. Thanks, Jim, and see everyone real soon.
Thanks, everyone.